Evaluating quality of financial reports. Here are the 7 sections in this reading. In section 2, we will cover the basic framework for evaluating the quality of financial reports. Section 3 gets a little deeper into evaluating the quality of financial reports. Sections 4, 5, and 6 deal with evaluating the quality of reported results. And in section 7, we will discuss the various sources of information about risk. This reading discusses 2 related concepts: the quality of financial reports and the quality of reported results. The quality of financial reports can vary greatly from company to company. When we talk about high quality financial reporting, we are referring to reports which provide information that is useful to analysts in assessing a company's performance and prospects. In other words, the information that is presented accurately reflects the economic reality of the company. On the other hand, low quality financial reporting contains inaccurate, misleading, or incomplete information. Low quality financial reporting does not adequately or appropriately reflect the economic reality of a company. Coming now to the quality of reported results. Here, think about the 3 major financial reports: the balance sheet, the income statement, and the cash flow statement. What we are talking about here is whether the numbers reported in these statements are of good quality or not. Section 2.1, Conceptual Framework for Assessing the Quality of Financial Reports. When looking at financial reporting quality, the worst case scenario is that reports contain information that is pure fabrication. The best case scenario is that the reports contain information that is relevant, complete, neutral, and free from error. Lots of companies will present financial information and financial reports that fall somewhere in the middle, and an analyst needs to be able to study the information provided and determine what is the level of financial reporting quality. If the financial reporting quality is low, then it doesn't even make sense to evaluate the quality of reported earnings or the reported numbers on the balance sheet or the cash flow statement. Only if the financial reporting quality is relatively high can we get into the assessment of earnings quality. In terms of earnings quality, the 2 extremes are shown right here. At one end, we have earnings which are relatively low and unsustainable. At the other end, we have earnings that are relatively high and sustainable. Combining these concepts, we can come up with a quality spectrum. At one end of the spectrum, we have financial reports that follow generally accepted accounting principles, and here GAAP is used in a generic sense. So IFRS would be an example of generally accepted accounting principles. So reports follow GAAP. They are decision useful in the sense that they provide information that gives us a good sense for the economic reality of the company. The earnings are sustainable and the returns are adequate. In other words, the returns either meet or exceed the cost of capital. This is the best case scenario. Coming one level down, we have reports which follow GAAP. They are decision useful but not necessarily sustainable. So we have high quality financial reporting, but the earnings quality might be low. Coming one level lower, we have reports which follow GAAP but biased choices are being made. So for example, assets that should be depreciating over 5 years are depreciated over 7 years. So that raises questions as to whether we can really trust the earnings numbers. Next, we have reports which are within GAAP, but there is earnings management. The earnings management could either be real earnings management or accounting earnings management. An example of real earnings management is where in a given quarter R&D costs are cut so that earnings look relatively good, but obviously what is being compromised is profitability in the future. Accounting earnings management can be done through making biased assumptions related to pension expenses. And there are several examples that we have studied earlier in financial reporting and analysis. Coming now to almost the bottom of the spectrum, we have non-compliant accounting. So we can say here that GAAP is not being followed. If GAAP is not being followed, there is no sense even evaluating earnings quality. And finally, we have completely fictitious and fraudulent transactions. What we've done over this slide and the previous slide is learning outcome A. We have demonstrated the use of a conceptual framework for assessing the quality of a company's financial reports. We now look at potential problems that affect the quality of financial reports. There can be issues with reported amounts and timing of recognition. A company might book more revenue than it should. This is called aggressive revenue recognition. Or the company could book revenue prematurely. The worst case scenario in this context is that a company books fictitious revenue. Notice that if a company books revenue early, that impacts not only the income statement but also impacts the balance sheet, because probably the accounts receivables will then be high. There could be issues related to conservative revenue recognition. So revenue really should be booked in this quarter, but for some reason the company pushes the revenue out to the next quarter. There might be an omission. A company might not recognize certain expenses, and this will tend to make earnings overstated, or certain expenses might be delayed. For example, a company should be booking warranty expenses in a given period but defers those expenses out to a later period. There might be an understatement of contingent liabilities. There might be an overstatement of financial assets and understatement of financial liabilities. The cash flows from operations may be manipulated, and we'll see examples of how this can be done later in the reading. There might also be problems associated with classification. Classification choices typically affect one financial statement and relate how an item is classified within a particular financial statement. There might be certain cash flows that really are cash flow from operations and they reduce CFO, but a company might show these as CFI. What this does is it makes the CFO appear higher than it should be. In example 2, we look at balance sheet reclassifications. I want you to pause the video here and read through this example, which is presented in an exam format. The company is taking some of its inventories and showing that inventory as other assets. So in a sense, this is a reclassification of inventories. Inventories is a current asset. Other assets are in the long-lived assets category. So what does this do? Look at question number 1. The reclassification of a portion of inventory to other assets will do what to days of inventory? Now, if inventory is understated, this means that inventory turnover ratios are overstated and days of inventory on hand will be understated. So the best answer is A. As a result of the reclassification of a portion of inventory to other assets, what will happen to the current ratio? Remember, the current ratio is the current assets over current liabilities. If the current assets are low because of this reclassification, that will bring the current ratio down. I have reproduced Exhibit 4 from the curriculum, which goes over various accounting warning signs, and I want you to carefully go over this exhibit. I'm not going to read it out for you because a lot of the material here will be familiar to you. It is based on level 1 FRA and level 2 FRA, so you can pause the video and go through these slides. Here we cover the potential issues related to misstatement of balance sheet items, and at the bottom, potential issues related to overstatement of cash flow from operations. Quality issues and mergers and acquisitions. Mergers and acquisitions provide opportunities and motivations to manage financial result. The material on this slide connects with a reading on mergers and acquisitions in corporate finance, and it also connects with an earlier reading in FRA where we talk about accounting related to merged and consolidated entities. Companies with declining CFO might acquire another company in order to boost their CFO, and the money that they spend to acquire might be shown as CFI. In fact, it will generally be shown as a cash flow from investment, and what this will do is it will make CFO appear higher than it should be. A potential acquisition may create an incentive for a company to report using aggressive accounting choices or even misreport. Now, this might happen both for the acquiring company and the target company. Think about the acquiring company. If the acquiring company is acquiring using part cash and also using its own stock, then there is an incentive to overstate earnings so that the stock price goes up, and then use this relatively high stock price to acquire the target company. The target company also has an incentive to possibly inflate earnings so that the share price goes up. Misreporting can be an incentive to make an acquisition. As you have recognized from earlier readings, the accounting related to acquisitions is not always very straightforward. So by making an acquisition, a company can complicate its financial reporting, and that will make it harder for analysts or regulators to identify any discrepancies or issues with financial reporting quality. The default accounting treatment for goodwill provides an incentive to acquirers to understate the value of amortized intangibles when recognizing an acquisition. Recall that when an acquisition is made, goodwill is the amount that is paid above the fair value of net assets. And then once a company has goodwill, it is not amortized, it is just checked for impairment. So by understating amortizable intangibles, what happens to goodwill? Goodwill is relatively high then. And remember, with goodwill, the amortization doesn't necessarily happen. So this allows companies to overstate their assets. It is possible that financial reporting follows GAAP or follows accounting rules, but diverges from economic reality. You can go through example 3 in the curriculum, which talks about the treatment of variable interest entities or special purpose vehicles. Here, a company creates a special purpose entity and uses that entity to make its own financial reports look better. Example 4 deals with asset impairments and restructuring charges. These can be complicated and there is a lot of subjectivity involved. So it is possible that a company shows restructuring charges that do not reflect economic reality. A classic case is Sunbeam, which is discussed later in this reading. Items that are commonly encountered by analysts include the following: revisions to ongoing estimates. A very simple scenario is where the useful life or the remaining life of assets is changed, or the estimates are changed. We should also look out for sudden increases to allowances and reserves. This will be a warning sign. We should look for large accruals for losses, for example, environmental or litigation related liabilities. Management may use items such as reserves and allowances to manage or smooth earnings. Generally, the investment community likes to see smooth and stable earnings. It is possible that the economic reality is such that earnings are volatile, but companies use accounting rules to make earnings appear to be smooth. When we as analysts evaluate financial reports that appear to be relatively stable, we need to determine whether that is the actual economic reality or are these earnings smooth because of some accounting related manipulation. As a general point, no basis of accounting can be expected to fully recognize all the economic assets and liabilities of a particular entity or company. As we have seen in other parts of financial reporting and analysis, there are certain items such as unrealized gains in available for sale assets that are categorized as OCI, other comprehensive income, rather than net income. We as analysts need to determine whether items that are presented in OCI should really be in net income, or there might be cases that some item is shown as net income but really belongs in OCI. What we have done over the last few slides is cover learning outcome B, explain potential problems that affect the quality of financial reports. Section 3. Evaluating the quality of financial reports. Prior to beginning any financial analysis, an analyst should clarify the purpose and context and clearly understand the following. What is the purpose of the analysis? What level of detail will be needed? What data are available? What are the factors or relationships that will influence the analysis? I hope you recall that this is material you saw when you started financial reporting and analysis at level 1. And at level 2, the last reading summarizes these points again. What is new about this reading is the concept of evaluating the quality of financial reports. In this context, there are two basic questions. The first one is, are financial reports GAAP compliant? And related to that, are they decision useful? In other words, can you rely on the financial statements provided by the company to make a decision on whether or not to invest in the company or whether or not to lend money to that company? The second part is, are the results of high quality? The results could be earnings numbers, the reported numbers on the balance sheet, or the cash flow numbers. Do the reported earnings provide an adequate level of return, and are they sustainable? This second question will be addressed in detail in sections 4, 5 and 6. Right now we'll focus on the general steps to evaluate the quality of financial reports. The curriculum points out that the steps presented here serve as a guideline. An analyst can choose to add steps, emphasize or de-emphasize certain steps, or change the order of the steps. My recommendation though is that since these are the steps given in the curriculum, you should learn them in this particular order. The first one is to develop an understanding of the company and its industry. Only when you understand the industry well can you determine whether the accounting standards being used are appropriate for that particular company. You should also understand what the competitors are doing and the accounting standards and assumptions that the competitors are making. If the company that you are analyzing is doing something different from other companies in the industry, then that should raise some question marks. You should learn about the management of the company. Specifically, you should understand whether they have any incentives to misreport. Number 3, identify significant accounting areas, especially those in which management judgment or an unusual accounting rule is a significant determinant of reported financial performance. This can vary immensely from company to company. Let's take a particular company with a very high pension liability. If such a company makes small changes in assumptions related to calculating the pension liability and pension expense, that can have a substantial impact on the reported earnings. So you need to be careful about this area. Number 4, make comparisons. Compare the company's financial statements and significant disclosures in the current year's report with the financial statements and significant disclosures in prior year's report. If there are major changes, you need to understand why those changes are happening. Compare the company's accounting policies with those of its closest competitors. Again, if the accounting policies are very different, then that will raise question marks. Using ratio analysis, compare the company's performance with that of its closest competitors. If the performance is much better than the competitors, then there should be a good reason. So if you find a situation where your target company does not appear to have any competitive advantage or strategic advantage, but the numbers, let's say the profitability is much better than the competitors, then that might cause some concern. You then need to dig deeper and understand why that is happening. Perhaps the reason is that the financial reports are being manipulated. Check for warning signs of possible issues with the quality of the financial reports. This refers to Exhibit 4 that I have shown you earlier. For firms operating in multiple segments by geography or product, consider whether inventory, sales, and expenses have been shifted from one division to another or one geography to another. Sometimes companies do this to make the sales of a particular area of or a particular product line look better than what they actually are. Use appropriate quantitative tools to assess the likelihood of misreporting. By studying these steps, we have covered learning outcome C, which says describe how to evaluate the quality of a company's financial reports. Section 3.2 goes into some detail with one particular quantitative tool. That tool is called the Beanish model, and this is the model. We calculate an M-score. The M-score is a score indicating the probability of earnings manipulation. It is a normally distributed random variable with a mean of 0 and a standard deviation of 1. So this goes back to level 1 quantitative methods. Normally distributed random variable, mean 0, and standard deviation is equal to 1. Now let's look at the variables which are used over here. DSR stands for Days Sales Receivables Index. It is the current ratio or the ratio of receivables to sales in the current period divided by the same ratio in the previous period. If this ratio is more than 1, that means that the receivables to sales number, that ratio is going up, and this might be a cause for concern. Maybe the company is pursuing aggressive revenue recognition, which is why receivables as a ratio of sales is going up. What I want you to do now is go through these other variables and make sure you understand what they mean. Notice that GMI is the gross margin in the previous period divided by gross margin in the current period. if the margin is going down, this could serve as an incentive for the company or for companies to manipulate earnings. This number shows the assets other than current assets and property, plant and equipment relative to total assets. So if other assets are going up, that will be a cause for concern. What I want you to notice is that with the ratios we've talked about, if the number is greater than 1, let's just take DSR, if this number is greater than 1, then that implies that the ratio has deteriorated. If a question like this shows up on the exam, chances are that all these variables will be given and the coefficients will be given, and essentially you will have an M-score and you will need to interpret that M-score. Let's say that you come up with an M-score of minus 1.49. What does that mean? The M-score is the random variable. So on this normal distribution, minus 1.49 will be somewhere here. The probability of earnings manipulation is this area over here. If you look at a normal distribution or a z-table, this area is going to be 0.068 or 6.8%. So with a z-score of minus 1.49, the probability of earnings manipulation according to this model is 6.8%. On the other hand, if the M-score is minus 1.78, then the number is somewhere here. The probability of manipulation will be less. The point is that the more negative the M-score, the lower the probability of manipulation. Notice that we start with a minus number here. So if we have DSR, GMI and so on, if these numbers are relatively high, then the M-score becomes less and less negative, which means that the probability of earnings manipulation becomes higher. Notice as the M-score moves to the right, the probability of manipulation becomes more. Now let's look at the sort of question you might get on your exam. Notice that all this information is given. The DSR is given, GMI is given, so all the variables are given. The coefficient from the Beanish model is given, so thankfully you don't need to learn this. The M-score is calculated for you, and in fact even the normal distribution work is done for you. So we are given the M-score of minus 1.231 and we are told that the probability of manipulation is 10.91. Now here's the question. Would the results of the Beanish model lead an analyst using a 1.78 M-score as the cutoff to flag XYZ, that's the company we are talking about over here, as a likely manipulator? So notice our cutoff is minus 1.78. So if our cutoff is minus 1.78, that's over here, and this particular company has an M-score of minus 1.2, so less negative, that means that XYZ company has a higher probability relative to what is associated with minus 1.78. So this is a likely manipulator. Just to put it in simple terms, if the number over here in absolute terms is less than the cutoff, then we have a likely manipulator. Putting it in terms of negative numbers, if the M-score is less negative than the cutoff, then we have a likely manipulator. Question number 2. The values of DSR, GMI, SGI and DEPI are all greater than 1. In the Beanish model, what does this indicate for each variable? To some extent we've talked about this. DSR is the days sales receivables index. This number is going up between last year and this year, and that is increasing the probability of XYZ being a manipulator. The value of greater than 1 for GMI indicates that gross margins were higher last year compared to this year. So this also increases the probability that XYZ is a likely manipulator. The value greater than 1 for SGI indicates positive sales growth relative to the previous year. Companies would be predisposed to manipulate earnings to manage perceptions of continuing growth and also to obtain capital needed to support growth. DEPI, the value greater than 1 for DEPI indicates that the depreciation rate was higher in the prior year. A declining depreciation rate can indicate manipulated earnings. From an exam perspective, I'd say that the Beanish model is important, but recognize that there can be several other quantitative methods. Variables that can be useful for detecting misstatement include accrual quality, deferred taxes, auditor change, market to book value, and whether the company is publicly listed and traded. Those are just some items that are mentioned in the curriculum. The curriculum also points out that there are limitations of quantitative models. Companies that are trying to manipulate are aware of models like the Beanish model, and they will try to do things in a way that these standardized models or these quantitative models do not automatically flag them. In fact, Beanish and company conducted a follow-up study in 2013. This is a few years after they published their initial model, which showed that the predictive power of the Beanish model is declining over time. The point then is that analysts should not completely rely on quantitative models alone. They should also use qualitative methods to assess quality.